In this short recording, we will review estimation of free cash flows. Free cash flows are used as important inputs in valuation exercises. That's why I refer to this presentation as a valuation primer. This is also a continuation of the earlier discussions that we had about cash flows. Let's start with the maxim, a well-known maxim in finance, which states that profit is an opinion, but the cash flow is a fact. And in finance, we care about facts rather than opinions. That's why free cash flow is an important concept. Let's define what free cash flow is. A free cash flow to the firm is the amount of funds available to all investors in a firm after the firm pays its taxes and meets its investment needs to sustain its operations. So we could define free cash flow as the cash flows that are available to be distributed to both shareholders and creditors. In some ways, we can define them as the capital providers to the firm. As we learned earlier, income is not the same as the cash flow for a number of reasons, which relate to the use of accrual accounting methods. If you recall, accrual accounting is transaction-based. That is, it records information on financial statements when transactions occur, not necessarily when a payment is received or when a party receives cash for the transaction. This aspect of accrual accounting requires us to make some adjustments to accrual-based measures of income to estimate free cash flows or the cash flows. We will see this process, and you're going to see that it is quite straightforward. The procedure for estimating net operating cash flows involves reconciling the dollar amount of an income statement account with the change in the corresponding balance sheet accounts. We have already demonstrated this when we estimated cash flows from operations of the firm. If you remember, we took the net income, add back depreciation, and also looked at the changes in accounts receivables, inventories, accounts payables, and accruals. So the balance sheet accounts used for the adjustment are those that are related to firm's operating cycle, such as changes in accounts receivables, inventories, accounts payables, and accruals. So essentially, these are the items that are making up the firm's net operating working capital. The formal definition of free cash flow is on the top line, which is equal to net operating profits after taxes plus depreciation minus net current asset investments minus net fixed asset investments. So let's define each of these items one more time, although you're familiar with these. NOPAT, or net operating profit after tax, is simply operating profits, that is EBIT, times 1 minus tax. So this is the after-tax operating profit. Net current asset investments are equal to change in current assets minus change in non-interest bearing liabilities, which are accounts payables and accruals. We also refer to net current asset investment as change in working capital requirement. We define this as change in cash, change in inventories, plus change in accounts receivables, close parentheses, minus change in accounts payables plus accruals. If you notice, I put a question mark next to the change in cash. There is a reason for that, because most of the time when we look at the change or when we estimate change in working capital requirement, we do not account for the change in the cash. The only time that cash is qualified to be part of this equation is when cash is part of the operating capital. That is when the cash is absolutely needed to sustain the firm's operations. Otherwise, we will keep cash out. So again, net current asset investments is equal to change in the working capital requirement. The last item in the equation is the net fixed asset investments, which is equal to simply change in the net fixed assets plus depreciation. Change in the net fixed assets is equal to the end of the period fixed assets minus beginning of the period fixed assets. And then we add back depreciation. We're going to see this in a little bit, one more time, more clearly. Let's look at this example to estimate the net current asset investments. Let's say XYZ Corporation experiences a decline in its accounts receivables from $100 million to $70 million. And it experiences an increase in its inventories from $150 million to $200 million. In contrast, its accounts payables increased by $40 million and its accruals declined by $10 million. So given this data or information, what should be the net working capital investment for this firm during the reporting period? So now we have all the information that we need. We have the change in accounts receivables, we have the change in inventories, change in accounts payables, and change in accruals. We can plug these into the equation and calculate the change in net current asset investments or working capital requirement. So the answer is here quite straightforward. In order to calculate change in working capital requirement, we take a look at the change in inventories. In this case, inventories have increased by $50 million. That's why we have a plus sign in here. Accounts receivables, in contrast, declined by $30 million. So therefore, there is a minus sign in front of it. Minus, close parenthesis, or open parenthesis, an increase in the accounts payables, plus 40. And a decline in accruals, minus 10. When we account for all the signs, we have 20 million increase on this side and a 30 million increase on this side. That means that our working capital requirement declined by 10 million. Or the net current asset investments is minus 10 million. What does that mean? That means that the firm now, from one period to another one, is able to operate with $10 million less investment in working capital. So that implies cash released from this investment. So the company does not have to maintain the level of investment it had in its working capital requirement in the previous period. So that is implying that we have cash released as a result of this change. So a minus sign in net current asset investments implies cash available to the firm. We are going to see the impact of this later on. Now let's look at the net fixed asset investment. If the firm makes investment in its net fixed assets, the cash generated by other sources such as operations can be used up to make those investments. In other words, additional investments in net fixed assets constitute cash outflows, which eventually reduces the cash that is available to investors. So we can calculate the net investment made into fixed assets simply by taking the difference between the end of period net fixed assets and the beginning of the period net fixed assets, and then simply by adding the depreciation to it. So let's look at this example. In this particular case, the company ZTOP starts the year with a net fixed asset investment of $400 million and then ends the year with $600 million, and the company has a $50 million of depreciation allocation for the period. So the change in the net fixed assets are calculated right in here. End of the period, beginning of the period, which is $200 million, plus depreciation of $50 million, period depreciation. So we have $250 million of net fixed asset investments. That means that now the company has to make this investment, and the cash that was generated from other resources will decline by this amount. So in order to calculate the free cash flows, we start with the operating profits or net operating profits, add back depreciation, account for the changes in the working capital requirement, and account for the changes in the fixed asset investments. So a quick wrap up about the terminology. We use the term change in working capital requirement for net current asset investments. Also, we use the term net operating working capital, or again, as I mentioned, the change in working capital requirement. So operating capital investments are a combination of net fixed asset investments and working capital requirements. So this is what we call operating capital investment. Simply also we could call net fixed asset investment plus net current asset investments as operating capital investments. So to go back to the definition of free cash flows, free cash flow to the firm is equal to net operating profit after tax plus depreciation minus net current asset investment and minus net fixed asset investments. Or we could, as we defined earlier, we could call this combination as the operating working capital investment. So that gives us the free cash flows of the firm. Just a quick side note, if the firm's depreciation is equal to net fixed asset investments, so this means that depreciation and net fixed assets are equal to each other, and the working capital requirement is 0, that means that the firm's free cash flows are not expected to grow going forward. So because company does not have any resources to facilitate growth, neither investments in fixed assets nor investments in its working capital. As a result, we will have flat net operating profits going forward. Let's look at this example to calculate free cash flows for this firm. Wells Water Systems recently reported $8,250 of sales, $4,500 of operating costs other than depreciation, and $950 of depreciation. The company had no amortization charges. It had $3,250 of outstanding bonds that carry a 6.75% interest rate, and its federal plus income tax is 35%. In order to sustain its operations and thus generate sales and cash flows in the future, the firm was required to spend $750 to buy net fixed assets, and it has to also invest $250 in net operating working capital. So essentially this is the change in the working capital requirement. So how much free cash flow did this company generate with this data, or given this data? Let's quickly take a look at that. So we have all the information that we need. We have the information that will allow us to calculate net operating profits after tax. We have the information about net fixed asset investments, and also we have the investment in working capital requirement, change in working capital requirements. So sales revenues are $8,250, operating expenses are $4,500, depreciation $950. So from here we could calculate sales minus operating expense minus depreciation, which is equivalent to EBIT, right? This is EBIT. Times 1 minus tax plus depreciation minus net current asset investments minus net fixed asset investments. So if we do the math in here, we plug all of these numbers in here to calculate. This is entire part is Notepad. And then we add back depreciation, subtract change in working capital requirement, and subtract net fixed asset investments. So free cash flows of the firm is equal to $1,770 as a result. Quite straightforward. Let's look at another example. This time, ABC Corporation reported $300 million of operating income as of end of 2000 something. ABC's non-operating income is considered to be negligible. This means that we can ignore it. During the same period, ABC Corporation's account receivables increased by $50 million, while its inventories declined by $30 million. Company's accounts payables and accruals each increased by $20 million. At the beginning of the year, the company had $200 million of net fixed assets. At the end of the year, net fixed assets increased to $220 million. And the company's depreciation allocation for the period was $10 million. Company's tax bracket is 34%, and we will estimate the firm's free cash flow as of end of year. So again, we have all the information that we need to calculate the free cash flows. We have EBIT as $300 million. We have the tax rate, so EBIT times 1 minus tax rate, plus depreciation. We are given the depreciation information in here. Allocation is $10 million. And then we have the data to calculate the change in the working capital requirement or net current asset investments. Similarly, we do have the data to calculate the change in net fixed assets or net fixed asset investments. So let's calculate each of these in turn. So if we take the change in the working capital requirement, we will start with the change in inventories, which increased by 30 million. Just double check. Inventories actually declined by 30 million. Company's accounts receivables increased by 50 million. So that means that 30 million increase reduced the available cash. 50 million decline in accounts receivables made cash available. So this is a resource. And then we have each accounts payables and accruals increased by 20 million. So as a result, we have $20 million of decline in the accounts receivable. We could just write this in a slightly different way. We will get the same result. So let's use the actual signs. The inventories, if we look at it in here again, inventories declined, so we are going to use minus sign for the inventories. And then we have increase in accounts receivables, which is plus 50, minus we have 20 million increase in accounts receivable, accounts payables, and 20 million in the accruals. So change in working capital requirement then is equal to plus 20 minus 40, which is equal to minus 20. That means that the working capital requirement declined by $20 million. This means that $20 million cash released from one period to another one. So the same result in here. I didn't want to confuse you, so I used the regular signs in here. And this implies a decline in the working capital investment from one period to another one. So let's look at now the change in the net fixed assets. Net fixed assets, the end of the period, net fixed assets are 220 million, beginning 200, plus the depreciation. This means that we during this period made $30 million of investment in net fixed assets. Now we can put all of these together, and if you look at the formula in here, EBIT times 1 minus tax plus depreciation plus $20 million that was released from working capital minus $30 million that we paid out because of fixed asset investments. This means that free cash flows that is available to creditors and shareholders is $198 million. So if you notice in here, the minus sign in working capital requirement turn into positive in here because simply we have this relationship EBIT times 1 minus tax, and then minus plus depreciation minus change in working capital requirement and minus net fixed asset investments. So if we plug the numbers in here, so I'm going to use only this part in here after this part. I'm not going to repeat this. So plus 10 is the depreciation minus 20, which is going to become plus 20 as it is in here, and then we have minus 30. So altogether, this adds up to $198 million of cash that is available to both creditors and shareholders. So let's look at another example. It is similar to the first example that we had. In this case, Bartling Energy Systems recently reported at $9,250 of sales, $5,750 of operating costs, and other than depreciation, and $700 of depreciation costs. The company had no amortization charges. It had a $3,200 of outstanding bond at 5%, and its income tax rate is 35%. In order to sustain its operations, the firm needs to make $1,250 of fixed asset investments or capital expenditures and $300 investment in net operating working capital. So based on this data, by how much did the firm's net income exceed its free cash flow? So first we're going to calculate its net income and then its free cash flow to see the discrepancy between these two. So the data is in here. Sales revenue is $9,250, operating cost $5,750, depreciation $700, and tax rate is 35%. This data in here, interest expense, is actually not relevant in our calculations because we are calculating the free cash flow that is available to both shareholders and creditors. But this is now necessary to calculate the net income. So let's calculate the net income. Sales revenues minus operating costs minus depreciation, we get EBIT. And then subtract interest expense, $160 of interest expense. Earnings before taxes, $2,640. And 35% tax on this, $924. And net income is equal to $1,712. Now let's look at the free cash flows. EBIT is $2,800. The net operating profit after tax is $1,820. Depreciation is $700. We need to add back depreciation in here. Net current asset investments are $300,000. We are going to subtract this. Net fixed asset investments, we are going to subtract this. So this is a plus. This is a plus, right? and free cash flow to the firm turns out to be $970,000. This means that the net income is larger than the free cash flows by a factor of $746. So although the profits of the firm are looking $1,716, net cash flow that is available to both creditors and shareholders are $970. So this sort of sums up the free cash flow calculations. We are going to use this later on, particularly in the context of valuation. So I will end this recording here, and I hope you can review these slides one more time. And if you have any questions, please let me know.